Today, I'll examine executive compensation and the difficult question behind it. How much is too much? Pay packages for top managers are designed to attract talent, motivate performance, and align leadership decisions with an organization's goals. But compensation can also raise questions about fairness, accountability, and whether rewards truly reflect the responsibilities involved. We'll look at the purpose of these packages, the arguments supporting them, and the debate over when executive pay becomes excessive. Executive compensation is a complete reward package provided to senior leaders, including CEOs, CFOs, and other C-suite executives. It reflects the scope and complexity of their responsibilities, not just their paycheck. The package typically has four parts: base salary, which provides fixed annual income; bonuses, which connect cash rewards performance; equity, such as stock or options, which can align leaders with long-term organizational value; and perks, including benefits and pension provisions. Together, these elements shape how executives are rewarded for leading the organization. This slide focuses on the anatomy of a pay package, and especially on the role of long-term equity incentives. For top executives, stock options and restricted stock units typically represent the largest portion of total compensation. The central idea is alignment. As a company performs and creates value, the executive's potential wealth is connected to that performance. This structure shifts attention beyond immediate salary and towards sustained company results over time. In other words, compensation is designed to link leadership rewards with long-term value creation. Executive pay is best understood through three economic lenses. First, the talent market. Truly effective leaders are scarce, and companies compete internationally for people who can deliver results at enormous scale. Second, agency theory. A meaningful portion of compensation and equity can align a CEO's incentives with shareholders, reducing tension between ownership and management. Finally, there's a complexity premium. Running a multinational, multi-billion-dollar organization requires unusually strong cognitive and strategic capabilities. Together, these ideas explain why the market can place such a high value on executive leadership. This slide shows how dramatically executive compensation has separated from typical worker pay. In the 1980s, CEOs earned about 42 times the average worker's wage. Today, CEOs at S&P 500 companies earn more than 344 times a median employee's pay, with the gap even wider in some retail and technology companies. The scale of this change is the central issue. It has intensified public and regulatory scrutiny, while also raising broader questions about fairness, employee morale, and social equity. This slide presents the case for high executive pay through three practical arguments. First, exceptional decisions can create enormous value, so a multimillion-dollar package may be relatively small compared with the returns it helps generate. Second, equity-heavy compensation aligns leadership with shareholders because executives benefit most when the company performs well. Finally, replacing a CEO is disruptive and costly. Competitive compensation can help retain effective leaders and avoid the instability that often comes with a major transition. Together, these points frame pay as an investment in performance, alignment, and continuity. This slide presents three concerns about high executive pay. First, the link between compensation and performance can be weak. CEO pay may continue rising even when a company underperforms, raising questions about accountability in the boardroom. Second, board dynamics can reinforce the trend. Friendly insiders and peer benchmarking consultants may contribute to a cycle where pay is consistently ratcheted upward. Finally, extreme pay gaps can affect the entire workforce, eroding morale, weakening trust in leadership, and potentially harming company culture and productivity. Executive pay is typically set through a structured board process, rather than a single decision. First, consultants benchmark compensation against peer companies. The compensation committee then reviews the company's strategy and establishes target goals. After that, the full board approves the pay package and its performance metrics. Shareholders also have a formal voice through the non-binding Say-on-Pay advisory vote. Since the Dodd-Frank Act of 2010, U.S. public companies have been required to hold these votes. Boards are not legally required to act on the results, but a vote creates an important accountability mechanism. This snapshot shows how executive compensation varies across major industries, while revealing a common pattern. Pay at the top is closely tied to scale, performance, and competition for talent. In technology, CEO packages can reach $50 million to more than $300 million, often through equity. In finance, bonuses are linked to trading revenue, but that model remains controversial, especially after the 2008 crisis. Retail shows the starkest disparity, with CEOs sometimes earning 500 to 700 times the pay of minimum wage frontline workers. Together, these examples explain why executive pay remains intensely scrutinized. This slide moves from regulatory compliance to the broader question of ethical governance. Regulations establish the minimum standard, but boards are increasingly expected to connect executive compensation with outcomes that affect society, including employee well-being, sustainability and diversity, equity and inclusion. Institutional investors and ESG frameworks are helping drive that shift. The key idea is that performance should be measured beyond financial returns alone. When pay is transparent and tied to meaningful outcomes, companies tend to achieve stronger long-term shareholder returns, aligning leadership incentives with sustainable value creation. The answer is not simply yes or no. The debate depends on values, evidence, and context. Defenders point to scarcity, value creation, and shareholder approval, while critics cite weak accountability, board cronyism, and inequality. The practical middle ground is reform, more independent boards, stronger performance links, and broader stakeholder measures.